welcome to the Everyday Pro Investor YouTube series. You got Evan and Brian here again this week. So, pretty action-packed week last week. We're going to go ahead and run through some bullet points there, talk about quite a few trades that we put on, and talk a little bit about what we're looking for next week. So I guess the first thing we'll talk about is gold on Monday. It jumped, especially the gold stocks, on Friday after close. Warren Buffett, it was disclosed that he took a pretty big stake in Barrick Gold. And that's pretty big news because Buffett has historically bashed gold. And so in typical fashion, anytime Buffett invests in something, it jumps. So not only did Barrick jump, but the whole GDX sector jumped as well. Evan, what did you make of this?
Yeah, I mean, we originally covered gold a couple of videos back. Actually, it's probably a couple of months back now. And I've felt very good about gold throughout this whole period. We ended up selling the positions that we had way too early. We should have kept a little bit on. They would have paid off in a big way. But yeah, I could see why he would make this move.
Yeah, you're right. We definitely got off the train a little bit too early. I mean, we still made great money on those trades, but they could have been 10 baggers instead of 2 baggers. Do you think he's getting on at the right time, or do you think he's a little bit late to the party?
That's what's interesting. I mean, I don't know. I really have no idea. I would think that he would have, if he felt as strong about gold, he would have made these moves earlier on. It's definitely interesting that he's making these moves right now, considering how much gold has gone up in the past couple of months. I really don't know.
Yeah, I think the next catalyst I see for gold would be if there's more stimulus, right? The potential devaluation of our currency. You want that hard asset in gold. I think it's kind of part of the reason you've seen Bitcoin move up too, right? People are looking for alternative assets that can theoretically replace the fiat money that now runs the world. Do I think that it's absolutely necessary to look at it that way? No, there's other reasons for these types of assets to go up, even from just the technical basis, gold and silver. Silver, has kind of caught up to gold a little bit, and we were in on that trade too. I think that silver probably has more potential than gold to move higher, but I think if one moves, the other probably ends up moving as well. But definitely an interesting move there.
If he's anticipating the purchasing power of USD to go down, would this trade make sense for him?
Absolutely, yeah. Anytime that U.S. dollar goes down, commodity prices generally go up. We've seen the U.S. dollar start moving down. Really to lows we haven't seen in 2-3 years. And you've got lumber at all-time highs. You got copper that's moved up. Obviously, gold, silver have moved up. Even crude has actually done okay. It's kind of held in there right at that $42, $43 level. So, a weak U.S. dollar is obviously bullish for commodities. So I think he could be anticipating more weakness there. I know some other experts are as well. So that's a good point.
Yeah, then last week, go ahead.
No, go ahead.
I was just going to move on to the next segment to cover Walmart and Home Depot, who both reporting earnings last week. Both crushed their earnings reports. We had Walmart, their e-commerce jumped 97%. And then Home Depot saw a 23% increase in revenue overall. And then we had Lowe's and Target both just crushed their earnings reports. So what are your thoughts on the retail space right now?
Yeah, retail is really, it's black and white right now. You're either killing it or you're getting killed. So you got all these retailers filing for bankruptcy, and then at the other side of it, you have Target, you have Walmart, you have, the Home Depots, the Lowe's. So obviously those are do-it-yourself and construction type plays. But any of these retailers that have been able to embrace delivery, e-commerce, that sort of thing, have really prospered in this time, and it's really just accelerated what was already happening. Companies that weren't investing in technology and kind of where the consumer was going, COVID's accelerated it, and now they're completely left behind where maybe they had 2 to 3 years before. If they didn't adopt technology, they would have been left behind. So there's definitely specific names you want to be in. I've liked Target for a while. I really wish I would have got in before earnings. I think their stock jumped like 12% or something on earnings, and rightfully so. They're doing a great job. And that was one too during the pullback. It got down to like $100. Big mistake on my part for not getting in that name, especially because I continued to like it. Anything you want to add there?
I was gonna say last year. I remember this time last year we were covering stock. It was like around 70, and
Yep.
we never pulled the trigger on that one.
Yeah, we liked it back. It was like May, June last year. And again, it's just one of those stocks for some reason we haven't pulled the trigger on it, and it's been a mistake, and sometimes you just miss them. Moving on from that, though, we did have the July existing home sales number come out. I think it jumped 24%. It may be at a record high. I'm not exactly sure on that, but I do know home prices did hit new record high. So sales are going up, prices are going up, rates are going down. Just talked to somebody a day or two ago. They got a 30-year mortgage, their first-time home buyer, and they got like 2.75 or 2.8% on a 30-year mortgage. All-time, low rates right now. For a first-time home buyer, that's absolutely insane, and they're only putting 5% down. So they're not even putting a full 20%, only 5% down, getting an interest rate you'll never hear of, especially for a first-time home buyer. And obviously that's going to drive prices up. We touched on XHB probably a little while ago. We made some money in that position, but it just came off a 10% move in 1 month. That's one of the best months it's ever had. What are you seeing for the home building and construction space, moving forward, Evan?
I would think that they would continue to be pretty profitable considering how low the supply is right now. As they continue to build homes, they should be able to continue to sell at higher prices. The only concern of mine would be, at what point do we start to see these interest rates creep back up? And when they do, how is that going to impact the buyer's ability to get loans, or will people still be looking to buy homes after kind of like this fantasy interest rate period passes, if that makes sense?
Yeah, I think that's a concern that I actually have as well. Interest rates are not, in my opinion, going to go lower, or much lower, I should say, than they are now. And I'm not saying they're going to ever get back to like the double-digit era of 30 years ago, but I could see with all this money coming into the system that we see some inflation in 2021 probably. I mean, you're actually seeing some of it now in certain segments as some part of the market struggles. Other segments, you're seeing inflation, you're seeing high demand. And I think that you could see interest rates, especially on like a 30-year, let's say, go back to 4% or something like that, kind of like they were early in the year. Before COVID, we actually were seeing interest rates move up a little bit before moving significantly lower. And I think that that's definitely a risk to home prices, to the demand. That 1.5% difference in interest rate on a 30-year on a large purchase like a house is a really big deal. So I could definitely see interest rates being a concern moving into 2021.
One of the things that you mentioned a little bit earlier was how difficult it is to get lumber right now. Lumber prices is going up. And one of the things I meant to do is research some suppliers that supply alternatives to lumber. Like you think of metal studs that replace your typical 2x4. And I meant to do that for this video, but I'll make it a point to do some research on some companies out there, suppliers out there this week, to see if there's any opportunities. Because I would imagine, as lumber continues to go higher, builders will look for alternatives in that space.
Yeah, especially, it's a good point you brought up, and I'm glad you brought it up. I was talking to several different builders recently, and fortunately they're larger builders. They're not having problems getting lumber, but there are lumber yards that will only sell right now to the larger construction companies and their most, let's call it VIP customers, because lumber is actually not only the price is going up due to demand, which is obvious, but there's actually a shortage of lumber right now. The supply side has been squeezed, and if you're a small builder, you could actually have some problems getting lumber right now, which is hard to believe, but it's true. And I think that, that obviously, like you said, if we can find some names that are some alternatives to lumber to use for studs and other things, I think that's a good idea, and I'm going to be interested to see what you find there.
Moving on.
Let's move on, though, to our next segment here. Talk a little bit about a couple of the trades we made last week. So I'll go ahead and take the first one here. Microsoft, right? We bought the 210 calls expiring on Friday, 8/21. Well, we ended up hanging on to those into Thursday, pretty much almost to close on Thursday. Ended up making about 70% on that trade. The stock moved up to 215-ish. It did break a little bit higher on Friday before pulling back. So we pretty much maximized our value there. We made about 70%. Really good trade there. That was short term, all technical based, and a nice little trade for us there.
And then we had Salesforce. We put on a 202.5 call end of last week, I believe. And the stock did really well earlier in the week as we were anticipating, and we ended up taking some profits out just to be safe. And then we held on to the other half. Sometime, I think it was Wednesday morning when the market opened, Salesforce had an unusual sell-off. It was a hard sell-off early on, so we were actually forced to take all of our profits. And then sure enough, the stock came down just below 201 and then shot back up and ended the week around 209. So those calls that we made could have been even more profitable. We made 275%, but it could have been much better if, I don't know if it was algorithms that kicked in and contributed to that early sell-off. It's just kind of an unusual sell-off considering how good of a week it was having. But I do know they have earnings next week. I know one of the smaller analyst firms moved it to a downgrade for some reason. Actually didn't look into why, but I don't know. I'm expecting a pretty good earnings call. What do you think?
Yeah, that analyst downgrade, I think it came from Loop Capital maybe. They basically were saying that because small businesses are hurting, Salesforce is going to hurt. But the reality is companies aren't going to get rid of Salesforce because they're hurting. It's such a powerful tool. I don't really see that being a huge impact on the stock, but I expect a pretty solid earnings report. What I'm curious to see, though, is you just mentioned, is that 209 is right at that all-time high. And going into earnings, I kind of don't like seeing stocks run up like that. You know, it's a risk that they're going to sell off even on a good report. We were looking for different ways to play this, but with the way the stock is set up and the way the premiums are, we couldn't find a way to play earnings. So we're just going to watch and see what happens. It's a good long-term investment. If you hold the stock, I would not be selling it just because of a potential, earnings bump the next 1 to 2 quarters. I think that this name long-term is obviously a great investment. Another thing we mentioned last week was Tesla. We had talked about some rate at the money call spreads that you could put on. Basically, you could risk $500 to make $500. So Tesla right out of the gate was flat for about 10 minutes, and then it decided to take off like a rocket ship. It went from 1,600. It ended up closing the week over 2K. Those spreads ended up, full value. So you basically doubled your money if you got those at open, like we talked about. And, the stock splits this coming Friday as well as Apple. So you're going to see those splits happen. I'm going to be really interested to see what happens with that price action when those stocks split.
Yeah, likewise, especially Apple. I'm just real curious. It's right up against the 500 mark right now. Not well over, but it's over the 2 trillion mark. And it'd just be interesting to see what happens when it actually does split. If you'll have, investors come into the space that couldn't afford the $500 price, and will now be able to pick up some shares at, I don't know what, maybe 120. I don't know what the math is in my head, but somewhere around.
Yeah, that's about right. Depending on where it gets to for Friday, it should be somewhere in the 120 to 130 range is what I'm thinking when it does the 4-for-1. So it will be interesting to see if that pushes the stock higher even more with other retail investors coming in.
And then we put on, we didn't talk about it in our previous video. I think we put this trade on after, but CrowdStrike, we released it to our members only. It was a call spread, which did 65% return. Any comments there, Brian?
Now a quick trade. We had given it some time. We had gone out to September, put on the 105, 115 spread just purely based on technicals. It quickly moved up to like 112, 113. And anytime when you have a call spread that you still have time left, you're never going to be able to get real full value. So with it going up about 65%, getting up near the high end of that spread there wasn't much more value we would be able to extract out of it without holding it for longer term. So we sold it. It was a nice quick profit. And I know our members were happy with that one. And then looking at a play for this week, we talked about Home Depot. They had great earnings. The stock actually pulled back a little bit after earnings and then went back up, I think, the next day. So it was basically flat in a couple days after earnings. Looking at the chart, the technicals look good. It looks like it's going to keep moving higher or flat to higher. I don't see a big pullback coming. So what we're looking at is a little bit of a complex option play here, but going out a couple weeks, looking at the 9/11 expiration, we're going to sell the 260 puts, we're going to buy the 290 calls, and then we're going to sell the 297.50 calls. So net with all that, you're going to pay about 20 cents. So really cheap options play, but you do have some downside risk because you're selling a naked put. But that's also why you're able to get this call spread for basically free. I think this is a really good risk reward here. I chose the 260 put because there was support there, and I don't think you're going to get there. So even if it does pull back a little bit, you should be safe at that 260 level, and you've got a really good chance of making some good money here. You could get some quick movement up to the upside, and you could probably close this thing out in a hurry, making 100, 200%, no problem. So really like that trade. That's kind of what we're looking for going into Monday. We're going to take a look at that and possibly put that trade on. We did not put it on yet, so that's kind of what we're looking at for a stock next week.
And then moving into our last segment here, last week we talked about the XLE trade. We mentioned that it was not our favorite trade, but it was a possibility. We actually ended up not taking it due to some technicals that we saw when we were evaluating or going into buying into the position. Trade just broke down. If you're in it, you should have exited it by now. And then you want to cover rare earth?
Yeah, I can do that. The other one we talked about was the rare earth metals ETF, REMX. So we talked about it was a lightly traded ETF, kind of a risky play, but the chart looked good. So this pulled back about 1.5%, kind of now down near the bottom of its trend line, not quite there, but it looks like it should still move higher from here. So if you're in this trade, don't exit it yet. I still like the setup here. But if it does break through the trend line, which there should be support somewhere around $40. If it gets below 40, you got to exit the trade. It means that the trend's been broken. But there's a little bit more downside. I think it's trading at 41 right now. Could come down a little more, but I see this thing moving higher if it holds trend. So I wouldn't exit that trade quite yet.
And then evaluating, we usually evaluate a sector, but don't really have a specific sector right now. Rather, we're just taking a look at the entire market, which it looks like the market could be rather flat for the next week or so. And we're kind of playing this through call credit spreads, not kind of, but we are. Brian, I'll let you talk about these.
Yeah, so end of day Friday, after the market made a little bit of move there, I went out and I sold about 2% out of the money. I went into the SPY and I sold, I want to say it was like the 247 call and bought the 248, so my credit spread, right? So you got that dollar strike difference. So I'm risking $100. Only collected about 10% on that, which is not what you normally like to do when you set up a credit spread. You want a better risk reward than that. But I really like the way the technical is set up. I could see the market staying flat, maybe grind a little higher, but there's no way I see it going up 2% next week. So I went ahead and put that on. I think it's a really good opportunity, high probability trade. And we're going to end up making money on this. And so that's what we did. I mean, right before close on Friday, we put on these credit spreads. And not a huge chunk of the portfolio. It's only about 1%. We're not going to risk a ton of money on a credit spread like this. There's not enough reward. But I think it's a good way to play the market right now when a lot of sectors are either still trailing quite a bit or they're right at their all-time highs. And I'm not looking to get into either one. I just think that the way the market sets up, this is your best play right now. So, anything you want to add to that, Evan?
No, I likewise with your thoughts there. I wouldn't expect it to move. Definitely not 2%, but I've been wrong before, so we'll see.
Absolutely. All right, well, I think that kind of wraps it up for the week. We do appreciate everybody watching, listening. If you're on the podcast, listening to us on the road, but go ahead, hit that like button down below. Go ahead and subscribe. That way you get all the alerts every time we put out a video. If you haven't already, go check out our website, everydayproinvestor.com. We're also on Twitter and Instagram. Go follow us there. We do like to post every once in a while, put up some free trades, make sure that So, we're getting the news out there, what's going on, and let's go out there and let's have a good week.